Welcome to another episode of Capital Ideas, where we explore the innovation that enriches our lives and the capital process that turns those ideas into reality. I'm Nick Morgan, co-host of Capital Ideas and founder of the Investor Choice Advocates Network.
I'm Mark Huraiti, co-host of Capital Ideas and senior legal director and policy counsel at ICANN.
And I'm Dara Albright, co-host of Capital Ideas and a very proud board member of ICANN. And today we are joined by David Duccini, the founder and CEO of Silicon Prairie. Silicon Prairie, David is going to get into that, but for those who don't know, David is joining us again. We've had him as a guest before, and we're so excited to have you on again. David is a capital markets innovator with an extensive history in building infrastructure across capital formation, tokenization, secondary markets. And we're excited to dive in and have you back, David.
Thank you so much for the invite to come back. Really appreciate the opportunity to catch up.
Excellent. So let's just start off. We did a little brief intro there, but Silicon Prairie has now facilitated over 50 million in capital formation across more than 50 campaigns. And that's with over 50,000 registered users. So that's a pretty extensive background there. And I'm sure you've got a lot of successes in there. And maybe you could tell us a little bit about what you've learned, what actually works, and what doesn't in retail-driven capital formation.
Yeah, that's a great question. It's literally it drives at the heart of what we do on a weekly basis, trying to find, founders and ideas that are investable. So the fundamentals, really haven't changed at all. I mean, there's a lot of myth and hype about how capital gets formed. Everything from, people, following these cargo cults of trying to worship, these angel investors to bestow gifts upon them, right? Fundamentally, we have to start with, okay, let's look at, what is it the company does or what is it they're offering? Like all businesses are a hypothesis, right? Unless they've been operating and generating revenue, a lot of what we see are very early stage. And so the very first thing I want to look at and determine, like, is this a business or is this a hobby, right? So is the founder, is the group, is the company, are they solving a problem someone they know actually has who's willing to pay them to solve it at a price point above what it costs to solve it? And that sounds trite, but if you can't check all three boxes, that's a hobby and not a business. And then we have what we call essentially, at the elevator pitch level, right? Do they have a clear, easy plan, right? Do they have a clear need for capital? Like if I don't know why you need the money, you're going to have a hard time explaining it to other people. Do you have an easy to understand business model, explains how you do or will make money? And lastly, do you have some plan to return that capital to your investors? This I call the sociopath test. And basically I say, if you're not willing to ask your own friends and family to invest in your big dream, you don't get to ask mine. And I've actually seen people in person like recoil, like, what if I fail? I'm like, okay, cool. Now I know everything I need to know about you, right? You're willing to take other people's money, but not your friends and family, right? So yeah, not welcome to the party. So, fundamentally that's, it's really just the core. Those are the table stakes. And then, we say, which doesn't work, right? You can't post and pray, right? You can't just go on the platform and expect it to rain, even though lots of my contemporaries like to brag about how many investors they have or how many transactions they've done. You ask these people after the fact, it's like, yeah, 95% of the money came from my own network. And now the smallest investors are the ones that were on the platform. And now I have all these little $100 investors, the ones we call the Benjis, right? The Benjamins, the barky little dogs. And so, yeah, it's, you can't post and pray. You can't spray and pray. You can't just, hire a marketing firm and spray out and try and do a bunch of spam, right? So fundamentally, capital flows in three tranches if you're lucky. First, from people who know, like, and trust you. Second, from people who don't know you, but they know someone who does know you. And they tend to be the most financially motivated. And the third, if you ever get there, comes from most likely paid media attention. So that's just essentially the core, the core table stakes, if you will, for what works in online capital formation.
With that kind of platform available, David, the online, so I'll call it retail sort of investing, you've argued that the traditional idea of going public, the way that it was traditionally done in the 70s, 80s, and 90s is kind of outdated. And you've suggested that really because of the ability to have a platform like yours, any lawful public solicitation is effectively going public. What does that shift mean in practice for founders and investors?
That's a great call, and thanks for recognizing that. A lot of people think that ringing the bell on Wall Street is like essentially, a coming of age celebration. It's actually like a Disney princess moment, right? They pay for that, right? One way or the other, right? They pay for that, that little private party. So, I think if you realize, and fundamentally, like, and I don't want to like downgrade the word crowdfunding because it's in the name of the rule, regulation crowdfunding. But I like to talk about the ability to do public solicitation, right? So in America, we've got really four ways to go public. You got regulation crowdfunding, and you've got some state-based exemptions that can also act as stand-ins, right? You got Regulation D, 506C, right? Public solicitation, accredited-only investors. You've got, of course, Regulation A, especially Tier 2, and of course, the classic S1, right? And these dollar amounts are not insignificant. I mean, $5 million for a lot of startups like that's a lot of money. That in some people's minds, that's calling it rich, right? Regulation D, no limit, practically speaking, right? Regulation A, currently capped at 75 million. I think the important part is one, recognizing that public solicitation is the same thing as essentially going public. You may not have essentially a broker dealer network that's out there as you're smiling and dialing, right, in boiler rooms trying to sell your stuff, right? But you are essentially doing that role yourself, right? You're selling to the public, especially if these are people you don't know, right? Versus the classic private placement. And I think the opportunity here for founders is to embrace that, right? To think of it as essentially as a going public moment and not, try and, pretend like their crowdfunding deal was the Benton debt option that they'd rather forget, right? And hope that someday some white knight's going to show up, right, and make all their dreams come true. And so I think it does change the sort of the standard of care when people think about, about raising capital and realizing that, look, it's not a one and done. Any business that's going to be successful is going to have successive raises, right, that go on. And ideally, we march you up through either a Reg D 506B to start, right? Maybe, a CF and a D co-offering simultaneously. And then, as you're progressing, right, eventually maybe, march you up to a Regulation A if it makes sense, right? The Regulation A is pretty awesome as a mini IPO. We'll talk about some of the numbers later on about, its actual utility these days, but there's some opportunities, I think, to tune that up. But I think fundamentally, if people start embracing the idea that they are in fact going public and that, using an alternative trading system, you can actually have some means to liquidity, that all the same sort of opportunities, rights, and obligations are there at a fraction of the price.
Right.
David, you've outlined kind of a roadmap of using Regulation CF, Reg D, and Reg A kind of in succession. And that's what the Jobs Act envisioned, I think, raising first seed capital through CF, doing a follow-on capital raise through Regulation D, and then perhaps eventually going public through Reg A. That makes a lot of sense. So walk us through how that actually works or doesn't work. And from a policy standpoint, what do you think needs to change to make that pathway more scalable?
That's a great question. I always kind of chuckle when I look at Form C. If you ever look in the upper right-hand corner, there's the office of the management office. They talk about the level of effort, the burden rate to fill out that form. I think last time I checked, it's like 50 plus hours, right? It's meant to be a light notice filing. It's kind of a big deal, right? So I think there's some opportunities. One, we'll talk about the mechanics of it. With regulation crowdfunding specifically, it still remains to be, it's currently the highest cost of capital for a couple of reasons, right? One is, the need to have reviewed financials if you want to raise up to $1 million. And again, there's no guarantee you're going to get there, which means you're just setting money on fire if you never get there. Even worse, if you have to do an audit. And practically speaking, it's not like an insurance policy. Like one, most people don't even read the financials anyway. Like I have the data, I track all the clicks on the platform. Almost nobody goes to the Edgar site. Almost nobody clicks on the financials. But it's just not an insurance policy, right? And again, it looks at it's like looking at the history. Like you're driving by looking in the rearview mirror when you should be concerned about what's the use of funds going forward. So regulation crowdfunding is still the highest cost of capital. I think it's a little ridiculous that you have to have your financials reviewed for raises up to $1 million. That's not harmonized with most of the state-based crowdfunding rules, which allow you to raise up to $1 million on your own financials. So I'd like to see that, that be amended. And then also, I'm not even sure having a full audit on a $5 million raise makes a lot of sense unless they pop the thing up to 10 million. Because again, this isn't really a protective spell. It's not an insurance policy. And by the way, the vast majority of people that are using these things are doing what are called zero-day accounting. In fact, I actually saw recently on a service provider's website, they actually call it the zero-day accounting package option for like a couple $1,000s. They'll slap together an audit on a completely empty company, right? So what does that do for us, right? Meanwhile, my company, which has been in business now for almost 10 years, we did a review because of our fiscal year. We're going to do a full audit, right? All in, I'll pay about $15K for financials, right? And that puts me at a disadvantage. Like I should get a free pass for just even existing for 10 years, right? That shows I'm able to, to at least run a successful business. So I agree that the laddering approach, right? Most people just raise capital, probably under a Reg D 506B, the classic private placement without actually filing. A lot of people around the kitchen table, get some checks, whatever. I think if they really want to kind of ladder things up, I think they should potentially fish out 506B first, then tack on a CF and a D co-offering, only if they can make the D have like a sweetener. So maybe like we've had issuers do this. So they're doing non-voting common in the regulation crowdfunding round, but they're doing a convertible note in the Reg D side, which again, it's a different structure. Angel investors are more familiar with that. And then, you can keep lather, rinse, repeating that. That's the beautiful thing about these exemptions. We've actually seen issuers like sort of perpetually it looks like one continuous regulation crowdfunding offering. Like they start it and then just keep filing CAs and they keep, sort of perpetually raising capital. And so it's very interesting from a financing standpoint. And there are some sort of businesses where it makes a lot of sense. Like let's set real estate aside, where real estate is like all or none. Like you have to have all the money to close on the property, right? But most businesses, especially retail businesses, may have a continuous flow of people who are discovering them. Like this worked really well for breweries. Like every brewery we ever did, they held their campaigns open for a full calendar year because somebody might randomly show up in month 9, discover the brewery and like, oh my God, this is amazing. I didn't even know this was here. And they wanted to invest, right? So that's why I think that if people start to think about their capital formation as a continuous flow, like it's a river, right? It's not like, a dam and a reservoir, it's going to break one time. I think, again, if we start to really sort of reframe our relationship, and maybe it's sort of, maybe it's sort of some kind of, weird relationship we have with money, thinking about it as being essentially a scarcity thing. If I get some, then you don't get some, or if you get some, I don't get some. I think if we start to think about the capital markets as being continuous and thinking that, we could, in theory, leverage the right exemption at the right time with the right security at the right time, I think it would dramatically change the way that people, the way that people approach this, right? Versus saying, okay, well, like I get a lot of founders like, okay, well, we just need enough money for runway for the next 3 years. I'm like, okay, well, time out. Nobody's going to give you enough money to, give you a day job, right? If you need a day job, go get a day job and make this your side hustle, right? So really getting people down to say, well, what's the actual minimum amount of money you could actually put to use as soon as you get your hands on it? And that instantly like, okay, well, I could use $100,000. Okay, awesome. Let's talk about that $100,000 and not the $5 million you think you're going to go get.
Mm-hmm.
I love that. I love how you also bring it back to the beer, because if you think about it, all online capital formation has all originated through beer, starting back with wit beer, who then became Wit Capital. But I love to have this conversation about really sort of the flow and the process and the whole life cycle. And maybe you could weigh in a little bit on, and both from the perspective of the issuer as well as the crowdfunding platform, on how important is it to have control of the full life cycle, from the structuring of the deal to actually issuing the stock and the shares to secondary markets.
Yeah, that's a really great question. And I think there's not enough time is sort of spent on that. Like really, I'll be quite honest, like my average sales cycle is like 18 months, right? If someone shows up and say, I want to raise money, right? I'll be like, okay, well, I'll see you in about 18 months, because they got to like make sure they got their operating agreement set up or their bylaws are tuned up, they have to be ready to take other people's money. And so in terms of thinking through essentially the ownership issue, right? In terms of maintaining essentially control, right? Which is what a lot of, capital formation is around. The bigger the check, the more control you give up, right? We can talk about why I'd rather have 1,000 investors at $1,000 a piece than trying to find one rich old white dude to write me $1 million check. But it really comes down to thinking through the corporate governance structure, right? So one, don't necessarily have just one class of stock, right? If you have a chance, maybe and if you've already issued, that's fine. You can just reissue and have a board resolution. And so I usually tell first time founders that what they ought to do is they haven't used the word ought to do. What they should consider doing is having 3 classes of securities. Have a class A, either for the founder shares with super voting rights. That's what I did at Silicon Prairie. A class B, which is your common voting, and a class C is your common non-voting. Your class C is your community or crowdfunding round. One alternate is to say, okay, well, all founders, we're going to go into class B, common voting, one share, one vote. We're going to set aside class A as preferred stock, as dry powder on the shelf, right? To use that as the attractant when you're trying to go get those bigger checks in the future, but have a non-voting class of stock, because most people in these offerings aren't investing for financial control reasons, right? And the dollar amounts don't really give them essentially the entitlement for financial control. And so I just dropped a podcast episode on, warning people not to invest in SPVs, because an SPV doesn't solve any problem that any investor has at all. right? Investors think they have to hide their crowd away from the the big fancy financiers. They don't want to know that they were sleeping around, et cetera. So it's it's kind of an abusive thing. So maintaining control really starts at the bylaws and the operating, the governance, if you will, for the company, right? And that's what can be protected even when dealing with accredited, sophisticated, savvy, seasoned investors, that they can then decide if they want to take that check or not, right? So that's where it really begins with, is thinking forward through in terms of, okay, well, if I'm going to raise in capital over a period of time, I should have some cans on the shelf that I can present to different investors at different times. That makes sense, right? And also realizing too, if you're a service-based business, you can do a revenue share agreement if you don't want to do just straight debt, right? So if you're a successful restaurant and you want to buy the real estate next door to put in a patio because you'll do 50% more covers in summer, great. You're never going to go public. You may never even open a second location, right? But you might have a passionate base of supporters that would loan you the money under either a straight debt or a revenue share agreement. So again, thinking through that, your financing's not a one and done. All right. So on the platform side, it makes sense to play a role in terms of what I would call investor relations as a service. Like, we want to know that this issuer has previously everything they've done up until the point when we meet them, everything that they've done is lawful, right? We don't want to potentially facilitate what might inadvertently be money laundering, right? For example. So on the platform side, we have to be sort of protective, right? To know that we've got good provenance of essentially the data, provenance around the corporate governance documents, as well as the shareholders and the cap tables. And we do that through our transfer agent. So when you get to a certain point, as you know, with some of these rules, they fixed the rules in crowdfunding back in 2020-ish. I think it was 2018. SEC said, look, if you're working with a transfer agent, you've got less than 25 million assets, you will not trigger the 12G reporting requirements. That's that old 500 non-accredited investor, 2,000 investor any class kind of rule. So I think the short answer is it really begins with the issuer themselves, right? Really setting themselves up for success and not being blindsided by essentially their investors. I've seen a number of people in town here get the big check, which, by the way, the news article is wildly different than the actual check they walk away from the table at the end of the day, right? Like, oh, so-and-so got a $2 million check from this, this angel investor, this venture capitalist, right? And in a private conversation, like, yeah, I saw the $2 million check and they showed it to me, but then they said, okay, well, $500,000 is going to go to your IT company that we own, and $500,000 is going to go to the marketing company that we own. By the way, you're going to be moving into a building that I own, and you're going to be paying above market rates because I got to get paid. And so here's your $500,000 check at the end of the day. Right. So I think really being thoughtful about making sure your governance is sort of, basically set it up so it protects you against yourself. And that if you really do want to, if you want it bad, you're going to get it bad. But you have to be willing to unwind some things, at least from a board resolution standpoint, to do it. And then after that, I think, working with a partner that's got essentially, a full stack, either in-house or a group of related partners that can help bring you all the way through, right? Getting you up to that moment where you've raised enough money, you broke escrow, you're dispersing, and then you're helping your investors with their tax documents every year, or there's a voting event, or you're coming back because you need more capital. I think it's just it's just as important to sort of pick a partner that can really be there with you as your capital needs evolve and grow over time.
So David, that's a great description of what a platform can do for early stage companies and helping them raise that initial capital. A lot of people, I think, might complain that platforms stop at issuance. In other words, they help the companies raise the initial capital, but there's a lack of secondary liquidity. Now, partly, by operation of law, there are restrictions on liquidity. Reg CF securities have to be held for 12 months. But how important do you think liquidity is? Is that a significant limitation to today's crowdfunding ecosystem? The absence of
100%.
Okay, maybe you can.
Yeah, 100%. In fact, one of our taglines now is, an investment without an exit was just a donation, right? Which, and I'm seeing the look on your faces. It's the exact same look I get from everyone's. It's like there's a pause for a second, like, oh yeah, I'm never going to cash out of that thing. So yeah, we think liquidity is everything. And there was, and there's an article, a scholarly article written a few years ago. I can send you a copy of it. Then basically it was a study of European crowdfunding, which has been in operation longer than ours. There was a secondary market in Finland, and these researchers, these academics, really they nailed it. They thought the secondary market was sort of the missing link in crowdfunding. And then what they'd found in their research was that issuers who declared that they intended to be listed on the secondary market went on to raise like 150 to 300% more money in the primary offering. Now that liquidity feature mattered more to the retail investors. The more seasoned investors are used to being stuck with something for 7 to 14, 15 years. But however, even with the seasoned investors, it did change the bias around opportunity cost. And so by announcing your intent to list on a secondary market, it unlocked who was willing to invest and how much. And so I think, part of the challenge is that mostly the vast number of these platforms are only funding portals. So they're not even full member broker dealers. They don't even get to benefit from, raises under Regulation D and Regulation A, which I think is a travesty. I also think it's a travesty that FINRA won't let them take the broker exams, because if they want a smarter, more well-informed, portal operator, they should be more welcoming to help them graduate up to full broker dealer land. And then, after that, it's just, getting the ATS was not a rubber stamp event. Like, it took Silicon Prairie 23 months to get our ATS registration, and we had to threaten to sue FINRA for tortious interference, and then get our legislative rep involved, and thank goodness Betty McCollum, vote Betty, called on the SEC. And then the SEC is like, well, FINRA, what are you doing? And like, well, we want them to be a 250K net PD. And the SEC is like, well, they can do this as a 100 net cap PD. And I'm like, what? I could have just put 100K in a bank account and we've been done. Oh, sorry, I guess we forgot to tell you about that. And so, yeah, in the end, that was it got them by the short hairs, and that pushed it through. So we got our ATS registration. So look, the reality is this: like, this is not a technology problem by any stretch of the imagination. Number one, it's education, right? Just being aware that this is even possible, right? We're still kind of in the early days of this thing. Like, all new ideas for all time take about 20 years to hit Main Street adoption. There's only one example I have, which I'll tell you if you want to know, where it got adopted inside of a year. But every major innovation took 20 years. The ATM, the cell phone, the microwave oven, they all took about 20 years to hit Main Street adoption. All right, so here we are, Jobs Act of 2012, okay? It didn't really get going until 2016, and voila, it's 2026. Guess what? That's only been 10 years of runtime here. We're at the middle of the story here, the middle of the awareness curve at this point. More people have heard of Bitcoin than they've heard of regulation crowdfunding.
Where are we in that life cycle for tokenization that you said, we're not facing necessarily a technological burden here? Tokenization, hot topic, been a hot topic for a while. How much of that discussion is, necessary, helpful, and how much of it is hype and not helpful?
Well, it's for sure 100% hype, and I'm okay with that, right? At least it's raising awareness for it. Okay, so here's the thing that's sort of packed in the tokenization, the cryptocurrency, the distributed ledger technology narrative, if you will, is this idea that people want sort of self-sovereignty, right? And that's just not really what your average retail investor wants or needs or even should have, right? Because again, not your keys, not your coins, right? And most of the chains didn't support the ability to sort of seize and freeze, right? And that's what we've seen now, now that we've had, now at this point we're at, so white paper drops in 2009, 2010, 16, almost 17 years of runtime now with blockchain technology. And so now we're at a point where we've got these additional layers of protection mechanisms built into the chains, right? So Bitcoin has had multi-signature wallets, right? It's got to take several keys to unlock this thing. There's now parallel versions of these things called multi-computation wallets, MPCs or MCPs, MPCs, but it's both. And so now we're at a point where we can actually layer in thoughtful control structures, right? So the issue, again, as you said, it's not technology. You can't just, again, it's not a force field. You can issue an ERC20 token. That doesn't mean you're going to have lawful secondary sales, right? And if it doesn't get onto the SEC's radar and someone doesn't actually make a lot of complaints, people got away with it for sure, obviously. And so we're at a point now where I think, and this is why, we were excited to launch our partnership with Stobox, is that we're now at a point where these layer 2 protocols on top of the existing chains can act as these control structures, right? Where you say, look, if this, then else, without doing necessarily smart contracts, right? The problem with smart contracts is that they can't be smarter than you, and they're mostly just white lists, right? So the thing that we need to have is we need to have thoughtful, sort of inspection when it comes time to doing a transfer, right? So look, if this is something issued in regulation crowdfunding, the technologist says, oh, well, we'll put a time lock on it for 1 year. You can't trade it. Well, that's fine. But here's the deal. There's 3 exemptions, thanks to the FAST Act of 2017, that says you can sell it back to the company. You can sell it to a closely related party, right? Or you can sell it to an accredited investor. So that blows your time lock. Okay, that doesn't work, right? Now you have these things like whitelist, right? The issue comes down to, again, it's not about the mechanical process of transferring the assets. Was it lawful? Was it seasoned? Is it restricted? Were the restrictions satisfied or lifted? Was it a control person, right? What you don't want to have is essentially facilitating pump and dump. And this technology is an accelerant, right? And once it's gone, it's sort of gone. We've sort of learned that, like, once the asset is gone, it can be liquidated somewhere else, right? There's no unringing the bell, as they like to say, right? So I think we're at a point now where I think we're at a point where it's actually real, or could be real. I think that we're getting to a point now, especially with things like the Genius Act and the Stable Act, and a lot of the attention we put onto stable tokens, which don't solve most people's problems anyway. I think we're at a point where at least, the narrative is there, where people are being thoughtful about, the real potential for this stuff. I am bullish on our ability to now potentially unlock lawful secondary sales, because again, it's amazingly cool in that this is essentially the last piece to really sort of fully disintermediate the legacy Wall Street apparatus. Like, one of the things that really sort of irritated FINRA is, one, we were nickel BD. Two, we had built a non-custodial system, without talking about blockchain, by the way. We built a non-custodial exchange system where we have the transfer agent in the catbird seat, right? The transfer agent registered with the SEC. Guess what? They can hold funds, they can hold securities, and they don't report to FINRA, right? So that was number 3, by the way.
Cut that.
So we built a non-custodial system. And now the beautiful thing about that is that will absolutely play in very well with things like, tokenized securities, and these layer 2 chains where you have multiple signatures in place, where again, you don't have to have a human there. Like, let's say if we have a conforming transaction, this was a crowdfund deal, and there's the investor, they're not a control person, it's been seasoned, and they want to transfer their assets to somebody, right? Well, it can take 2 of 3 keys to unlock that thing. It can be the investor and the transfer agent. It can be the investor and the issuer, or it can be the transfer agent and the issuer, right? So when that transaction comes in, naturally the investor is going to sign off on it. Then it just takes 1 of the 2 other keys to sign off on it. Now, ideally, the issuer themselves is going to delegate that that role to the transfer agent, potentially, right? Now, let's say it's a control person. Maybe we require 3 of 4 keys, right? Investor, issuer, transfer agent, and outside counsel, right, to unlock that. So, right, and so then depending on where you're sending it, that sets the new rules around how it's locked up. Right. So this is how you could take and essentially remove the boot off the Ferrari, again, by having the transfer agent. And the nice thing about having a blockchain-based system is, if you think about, having all the public officers, listed on places like, the old Yahoo Finance, right? Well, if we have the public, the control persons, right, with their public keys identified, like, we all know the second they're buying or selling, right? Mm-hmm. So there's none of this, delayed filing. Oh yeah, by the way, sorry, I sold a bunch of stock 3 months ago. Just telling you now, right? We know the moment it hit the chain, right? So I think it's gonna be a huge unlock for a lot of reasons. I think it's gonna also provide a lot of transparency in terms of no phantom shadow cap tables. You're gonna see exactly mark to market what the current if you even have essentially a market cap allowed. But it also can support things like essentially, private transactions. Like, we really think our role at Silicon Prairie is to play a role in the private restricted market. Like, we're not going to be an exchange anytime soon, and we really think that issuers have a right to know who's on their cap table. So these kind of technologies, I think it's finally it's finally arrived. It's been 10 plus years into it, and I think now we've got enough sort of runtime, and I'd say enough smart people on it, and the people that are really not just like these crypto anarchists and not trying to cowboy it, right? I think people are actually really thoughtful, like, hey, we want to line up and be compliant, and by the way, we'd like to make a bunch of money lawfully doing it.
Did you see the same innovation then really going to the existing public market infrastructure as we have today, and basically making even that system better? Because we still can't find out, instantly when an insider is buying. There's still a whole process there. Do you see that's where it's headed in the public markets?
So far from what I've seen, with DTC and their approach, the DTC has its own sort of challenges. Like, they're dealing with like a 300 million line COBOL monster, right? And everyone who wrote that stuff is either retired or expired at this point. And their design is not, doesn't really contemplate the kind of unlocking, as it will, because why would they, right? I mean, the vast majority of stock in this country is held in Seed and Co, right? I mean, just it's kind of mind blowing when you think about, okay, who does actually the stock owns the stock in this country, right? And again, there's also, I think, an unholy fascination with, the public markets, right, which represent a tiny fraction of the number of businesses. I was just joking with somebody recently, like, the Wilshire 5000 should be renamed the Wilshire 3400, right? It doesn't even track 5,000 stocks anymore. So I don't know that it's going to do anything dramatically to unlock public markets. I think extended hours trading, is going to have maybe more of an impact. I saw recently that the Federal Reserve is going to start doing wire transfers on Sundays. And so I think there's some mechanical back-end plumbing that's going to help, improve the velocity of money. But I just don't really see it being any kind of real big deal in the public markets, unless it's as a story where it was something that was natively issued originally on a chain and then, had exposure, into the public market. But I mean, the idea of tokenizing your Disney stock, who cares?
So tokenizing Disney stock, I think a lot of people contemplate that, younger people who are accustomed to trading, crypto trading, for example, on platforms like Robinhood and Coinbase, if they're given an opportunity to invest, tokens may be more familiar to them than a share of common stock. And you can fractionalize the security token of Disney and sell them at a fractional cost. What role do you think the investment banks should play? So, for example, you had mentioned the diligence that a transfer agent may be involved in to understand the provenance of the security to determine if it's freely tradable or not. Right now, broker-dealers occupy that function. FINRA, as you know, is very strict about broker-dealers trading securities that are newly issued and arguably freely transferable. I mean, I'm envisioning assuming that all the banks, all the Wall Street gets involved in tokenization of securities in particular, but tokenization of assets in general, and individual retail investors, again, mostly younger people who are accustomed to transacting on their phones, are trading in tokens. What role do you see for Wall Street playing? Are they going to be the behemoth that just takes over and, cannibalizes all the financial services activities that we're talking about?
That's a good question, and I think the thing that the opportunity with tokens and the upcoming generations, like, so I've been working as a fractional CIO at a little baby bank, and it's been super interesting and super valuable. And the idea is that people don't know, but first of all, banks aren't what people think they are. Now that I've been doing this deep dive, I've seen how they function, they dysfunction. But really, the kids these days, right? They don't think of a bank. They think of it as a score on the screen, right? They don't think of, like, even in these online games, they don't have to go to a bank to transact. Like, it's just, it's instantaneous, right? And so I think where it comes with tokenization and possession, it's like proof of participation. Now imagine the Disney story, right? Let's say you roll up to Disneyland and you fire open your Robinhood app and you show that you're an owner of Disney stock, right? They can scan a QR code and you might get free entry to the park or something, right? That kind of thing. That's where I think there's a real big opportunity for having sort of possession of your ownership interests, right? Is the sort of things it could unlock. And I think we're going to see more of that with this creator economy. Like I was just talking about recently, like, we're sort of bypassing the idea of the rise of the knowledge worker, right? Where, thanks to COVID, which is just a weird thing to say, thanks COVID, right? We get to work from home, right? And all your smart knowledge workers are portable now. That, all these attempts to force people back into the office just sort of universally failed. Like, nobody is talking about it anymore because all the smart people, like, I'm going to go someplace where I can just keep working from home, right? So now we're in this rise of the creator economy. And I think you're looking at people, the younger generation, they like experiences versus things. And so I do think that tokenization plays a big role. Now, back to your question about Wall Street. What is Wall Street? How are they going to play in this thing? I think the ship has largely sailed on that point. They were dragging their feet for so long. And here's the deal: like, these protocols don't require anybody's consent. They don't need their permission. And I think that the smart people are going to just simply bypass, and make it essentially largely irrelevant. Like, I mean, the vast number of broker dealers is continuing to shrink. The number of banks is continuing to shrink. I just don't know that, that retail brokerage experience is even really a viable business model other than for the largest companies. And Robinhood has demonstrated, like, they leapfrogged, the Schwabs, the TD America trades, of the world by going right to, direct to consumer. And so I just don't know that, at this point, as trusted intermediaries, maybe as, building the syndicate groups, around maybe if we can relight or reignite the whole IPO side of things. I think that's where they would have an opportunity to be more relevant. right now, the average age of your person at a broker dealer, minus all the retail, whatever, like these people are going to expire if they can't sell their broker dealers off at this point, right? The business, the fund's been sucked out of it. And so I just don't know that Wall Street writ large, really has much of a play left, especially since, most of those offices are empty anyway. And, this is a 24/7 global economy. I think that's what we're going to start to see is a lot more sorts of, cross-border transfer flows happening totally off the rails, like totally outside. That's the thing that stablecoins does, is it takes all that money flow outside of the Federal Reserve's purview, which is the thing I think that freaks them out the most. But now at this point, they can't stop it.
You're currently raising capital on your own platform, as you say it, eating your own cooking. So maybe you could talk a little bit about how your cooking tastes and what that means, and what how that really kind of helps improve the system that you've built and tested out.
I appreciate it. I think my actual phrase was eating your own dog food. And one of my advisors has encouraged me to say, drink your own champagne. It's like, yeah, I'm a brewer, not a vintner. So yeah. So the beautiful thing is, yes, we're raising capital on our own platform. We have a Regulation D offering open. You can find it out off of our main website, sphi.io. We also have a regulation crowdfunding offering. It's on our platform as the technology company. We're using one of our platform as a service operators. Crowdfund Ideal was gracious enough to host our offering, since we're not allowed, weirdly, to host our own Reg CF offering. I don't know how that got in the rules. It's ridiculous for a variety of reasons. But the cool thing is it's not our first rodeo. So when we launched back in 2016, we immediately went to work on doing a raise for ourselves under our Minvest rule, our state-based Rule 147, Board 47A inspired crowdfunding rule, which allows us to both be the platform operator and the issuer. And so everything that it's like everything old is new again. So now we get to experience, through the eyes of our clients. And I'm pleased that, we built a system that fundamentally, at the end of the day, we're a licensed bill pay service for securities, right? An honest platform operator is going to tell you that, look, I just help you, I help your investor put the security into the shopping cart function, and then I get them under the checkout function where they own the security. And so it's been pleasing to see it operate in a very low friction environment. The reality is that this still requires marketing. We haven't really started with the marketing. We were racing to get the thing launched so that we could, begin, getting the story out and, begin accepting funds. That our marketing for us, it's going to be a long, like we plan to keep our opening offering, up to the full calendar year, because what we're doing is we're putting in an investor perk we call a founder forward credit. So for any investor that puts in $5K, they will get a prepaid portal launch credit on Silicon Prairie to launch their offering in the future. And that can be under Reg D, Reg CF, or Reg A. And so that's one of the ways it's actually something we did in the earliest, the very first time we raised capital back in 2017, we had the exact same perk in there, which helped, kind of pre-seed, kind of the sales in the pipeline. So we're using essentially our raise as a marketing tool. And that's how everyone should really use their raise. It's both marketing as well as financing. And again, the perk I have to offer is I can offer, portal services. And so, it's been working, working really pretty well. It's, we're slightly different messages between the two different offerings. So for the Reg D crowd, we're really socializing. Look, we're going to go buy a piece of a baby bank. That's kind of our primary use of funds. On the Reg CF side, we're really trying to drill into the whole ATS story as really the primary motivator, right? So your regulation crowdfunding, nearly $3 billion has been raised, $2 to $3 billion, and almost no liquidity. Right. So we really think this is sort of the unlock, especially when people start thinking, okay, well, now how do I get out of this thing? We've already got the operating stack. People are talking about tokenization. They're talking about ATSs. We have the entire stack already in hand. Now it's just a matter of educating people and hopefully bringing them along as part of the ride.
You've been outspoken. This is a hard pivot here away from that discussion, but you've been outspoken about regulatory overreach, particularly regarding FINRA. Where do you see the biggest inefficiencies in the current regulatory structure? Is this too much regulation, the wrong kind of regulation? Is it the people, the individuals applying the regulation? Where's the problem, you suppose? Or is it all three?
We don't have enough time. Right. Yes. So let's just start. I feel like I have to have like a prepared statement before I say it's like, I'd like to take a moment, state that my opinions are my own. They don't reflect on my company, blah, blah, blah. But FINRA is not the government. They're a not-for-profit, member-based organization who work for people like me. The SEC has sort of abdicated all control. Like they were really surprised during my whole run-up, like they were surprised, like, well, don't they have service level agreements? Like, that's a good question. Why don't you and your vendor management program go and check on your vendor? So it's a combination of one, these people, one, they didn't work in industry. Two, it's well known that the vast majority of people at FINRA can't pass their own exams. And three, it's essentially an artifice of a structure that's no longer necessary in an internet era, right? They really think of themselves as being in investor protections, yet no investor hired them to protect them from themselves, right? They are insinuating themselves into a process. Like even with our ATS diagram, it's like, look, okay, here's the broker dealer, here's the transfer agent, here's the issuer, here's the buyer and the seller. Guess what? There's only one party here that reports to you, and that's the broker dealer. So I think the reality is that you've got this bloated infrastructure that's been operating essentially kind of at the edge for far too long. Looking at some of their their annual reports, I was surprised to learn that 80% of the revenue comes from 50 broker dealers. Well, there's like 2,000 broker dealers. So why don't the rest of us broker dealers just go report to the actual government directly, right? So I think the writing's on the wall. Take Project 2025 for what it is, but it seems to me that there is a collision course between the CFTC and the SEC potentially merging, possibly in the second Trump administration. They just signed a MOU about a week ago, kind of saying they're going to work jointly on these, digital assets. And so you have to ask yourself, does an organization like FINRA still have any kind of relevance? And here's the hard truth. Like I was explaining this to one of my portal operators. She's like, oh yeah, I just had to get online with FINRA and pay my annual fees. I'm like, well, what was it? It's like, well, it's $1,200. I said, cool. How much money do you think they've spent, harassing you over the last year? And he's like, well, I mean, a lot more than $1,200. I'm like, yeah, well, how is it that an organization that collects $1,200 justifies spending more than $1,200, with their time, money, morale, and focus on your attention, right? They weaponize their attention against you. He's like, I don't know. It's like, they're looking for fines. That organization is looking for ways to fine you because they can't make money. They're not actually value priced. They're not even right priced on what the actual services they offer. So if you actually ran that thing like a for-profit company, one, it would have half the staff that it has in place today. And two, they'd actually give a shit about their members who are paying their bills, right? So I think the problem here is that you've got essentially people at the SEC has sort of abdicated control over the wall to FINRA, thinking that they're monitoring this stuff, right? Meanwhile, you got FINRA who basically gets to run with scissors because nobody pushes back at them, right? Like, we're from the government. You got to answer our calls. Like, I don't report to you, right? Like I had, they've been harassing me on our, some of our banking relationships. And finally, my bank's lawyer says, look, if they come back again, Robert, we're going to file a tortious interference lawsuit with them. We don't report to FINRA and we don't report to the SEC. They don't get to tell us how we process checks, right? So it's just really, it's a matter of, one, I don't think the people there know who they actually are and really don't understand what their role is in the capital markets. So in a nutshell, love you guys.
You just described a lot of the same issues we're looking at. So
right. Exactly. Yeah. I mean, that's where I'm bullish on AI. Like I would really, I think you could replace, and if FINRA doesn't, get wound down or get abolished, or if we don't get the ability to report to the SEC, I'm on board to try and, maybe as my lovely parting gift when I cash out Rich is to set up a competitor SRO that's based on a cooperative model. And we put an AI core at the middle. And then we just have all the members, act in terms of various committees, et cetera. Because in the internet era, we can achieve consensus without having, experts, in the background trying to make sure that, they make their paycheck every couple of weeks.
I look forward to seeing that project take off.
Thank
David.
you. Thank you. Thank you. It'll spread like poison ivy.
So if we fast forward 5 to 10 years, what does a fully functioning modern capital market actually look like?
That's a great question. I think we're going to continue to see consolidation, right? So I think we're going to see, where it becomes essentially the sort of step cost to run some of the stuff. Like even like in my time looking at banking, like these baby banks, right? The costs keep going up because of inflation, their cost for their software, their cost for their salaries, their cost for their IT infrastructure. At some point, the 4,000 some odd banks could instantly turn into 2,000, could turn into 1,000 banks, really with not a lot of, stretch of the imagination. I think we're going to continue to see consolidation. We're going to continue to see a flight to quality in this space. I think we're going to see a lot more, I'm not going to call it necessarily self-issuance, but we have enough technology. And again, technology has not been the problem, but I think we're going to see a lot more, people that are plugging into platforms and economies and tapping into, really the capital side of things much more directly without the intermediaries. Like I'm still a fan of having intermediaries, and that's not for selfish reasons. I think there's really good reason to have at least somebody with some oversight on some stuff. So Florida recently changed their crowdfunding rule and they got rid of the intermediary requirement, which, I think was a mistake. And again, I don't know that it's caused any harm because I don't think anyone's used that law at all. Quite honestly, I don't know if there's been any offerings under the Florida state-based crowdfunding law. But I do think that, one, we're going to see continued contraction. Two, we're going to see, some acceleration in terms of technology. And I do think we're going to see much more of a creator kind of economy emerge here, where people are going to start monetizing their own brand in different ways. And now, because of things like tokenization, we have the ability to do things like, royalty rights, right? Very simply. So there've been several experiments where there's several platforms that say, well, we'll pay you depending on how long they actually watch your podcast, right? And so we'll pay you per second or whatever, per minute or whatever. And so I think we're going to start to see a lot more of that as it rolls forward, and we're going to continue to see, more of the legacy Wall Street apparatus, really just kind of take a back seat. If we can sort of, fundamentally change the narrative on what it means to go public and try to unlock the IPO. And I think, I'm a little bullish on, what I've seen out of Atkins, like the idea of, maybe getting away from quarterly reporting to go to semi-annually reporting might take some of that obsession and expense out of the space. But I do think we're going to see, an unlocking here of capital flows, with things like tokenization, with the creator economy, and with, again, just the natural, contraction, of the legacy apparatus.
Yeah, I agree. I think that, with respect to large cap publicly traded companies, we have the plumbing system in place and nothing is going to change too much there. But with respect to earlier stage investments, I can envision an economy where young people want to invest in, the next startup, and they're going to be able to do so without friction on their phone. We're going to have secondary trading, most of which will be over the counter. So we're still going to have the difficult challenges with respect to regulating, compliance with the securities laws. But I think the brokers, the Robinhoods, and Coinbase, when it starts trading securities, are going to have to deal with that. But hopefully, with a frictionless economy and ecosystem, we'll have a lot more capital formation and liquidity.
Yeah, I agree. I think the thing that's interesting is that, especially with service-based businesses, it's a lot like, buying a prepaid, spend card, right? So the money is already in. So if you went to a restaurant and you bought a gift card, right? The restaurant already has the money, right? And you spend it down over time. I don't see why, in terms of, the fundraising side of things, that, that same sort of thing, couldn't hold, especially if you had a revenue share agreement. Like we're talking now with a group about, that's a real estate platform. They want to shift into performing assets. Well, now that I have access to banking infrastructure, we're talking about putting a debit card out there under their brand, where those performing real estate assets, right, that money, those rent checks every month gets deposited into an account that's linked to that debit card, right? So those investors essentially could have access to that liquidity, right, essentially in the other parts of their life.
Wow. David, you paint an exciting picture of the future, and you're a part of it, which makes you a great person to check in with every once in a while. So we're so thankful that you came on a second time. I feel like we should pre-schedule your third, turn.
Let's do it.
Hear what you're up to. So thank you for coming on. Thank you for sharing your thoughts. Dara and Mark, thank you as always for co-hosting. For everybody else, if you want more information about ICANN, go to icanlaw.org. And otherwise, we will see you at the next Capital Ideas. Thank you.